This is Macro Analytics, delivering frank conversations on global macroeconomics and market analysis, outside the mainstream, featuring discussions and debates between Gordon T. Long, publisher and editor of GordonTLong.com, and his guests. The content of this discussion is strictly the opinion of the participants. It is in no way a solicitation for business, nor is it to be considered investment advice of any sort. Always consult a registered investment advisor before making any investment decision. These discussions are extremely hard-hitting and terribly frank, and parental discretion is advised. Now, on to the show.
Good morning. It is Wednesday, July the 8th, 2015. I'm Gord Long at GordonTLong.com. A reminder before we begin, do not trade from any of these slides. They are commentary for educational and discussion purposes only. Always consult a professional financial advisor before making any investment decisions. The purpose of the audio slides is to talk about the areas that are not updated in your monthly analytics and technical analysis report. This is based on our annual cycle as outlined on the subscriptions page on our site. We intentionally keep the technical analysis charts to the subscriber report so as not to confuse them with the drivers operating behind them. Drivers in the long term are primarily the fundamentals, in the intermediate term risk, and in the short term confidence and sentiment. This month I would like to cover a range of topics listed here. I'd like to talk about the market extremes, kind of recapping some of the things I've talked about in previous months, but the newer levels that we're now at in some areas. The market turmoil across all markets, and talk about each of these markets shown. And what I'm now seeing as hidden agendas that are coming out from hiding. Through Greece, through Puerto Rico, through other situations such as Illinois, city of Chicago, I am seeing a number of precursors of what I think is in store for us going forward that may become, or has a high probability of becoming, standard operating policy for heavy debt-laden governments. The decay vortex I'd also like to touch on, though I'll expand a lot more of it in this month's global macro tipping points. We have talked in our GMTP service and our financial repression video interviews about what we suspected was ahead for the developed economies as macro-prudential monetary policies continue to be hurriedly implemented. I'd like to discuss this in the context of the unfolding developments in Greece and Puerto Rico. I believe they give us some insights into areas of bank bail-ins versus debt relief, negative real interest or negative nominal interest rates and negative real interest rates, as opposed to and in concert with a cashless society. Helicopter money and the presidential campaign platforms, and ATM restrictions and capital controls as weapons. The central banks, government bureaucrats, and international banks are being forced to what they see is coming. They know they simply can't take on more debt, guarantees, and contingent liabilities. That is becoming evident and a clear fact. The real global leaders, and I differentiate those from the revolving political talking heads we listen to, are acutely aware the global economy is not growing fast enough to support revolving and new debt needs, which the debt-addicted developed economies have become so dependent on. This is shown right here in these kinds of situations, from the Greece referendum to the recent Chinese market collapse. I think we should first consider the environmental backdrop these very serious developments are occurring against. Valuations, by any measure, are at historical levels, as are corporate profit levels. It is difficult to see how both can be sustained much longer, and certainly much higher. We have talked extensively about this with many charts in previous sessions. The broad array of technical indicators, oscillators, patterns, etc., that we follow in the written report also suggests markets are due and in need of some level of correction or minimally consolidation. The length of time since we've had any meaningful market pullback has fostered speculative fever in terms of margin debt, seldom seen before. These are margin debt levels not seen even prior to historic market crashes. We have geopolitical event risk that is dominating the daily headlines, which on the surface appears to be having no effect on complacent investors. We have talked previously about major issues in the areas of liquidity, collateral, velocity of money, and custodial risk. None seem to matter, at least not yet anyway. The problem is that in addition to regulation, central banks' distortions of markets has reduced the heterogeneity of the investor base, forcing them to be the same way all around over the past 4 years, even to a greater extent than ever previously. This creates markets which trend strongly, but are then prone to sudden corrections. It also leaves investors more focused on central banks than ever before, and is liable to make it impossible for the central banks to make a smooth exit when that time comes. There is a widespread notion that the problem is solely due to regulations having raised the cost of dealer balance sheets and could be ameliorated if only there were greater investment in e-trading or a rise in non-dealer to non-dealer activity. To be sure, we see the growth in regulation, leverage ratio, and net stable funding ratio in particular, as one of the main reasons why rate markets are now starting to be afflicted. And indeed, we expect further declines in repo volumes to add to such pressures. But illiquidity is a growing concern even in markets like equities and foreign exchange, which use barely any balance sheet at all, and where e-trading is already the norm rather than the exception. Worse still, it is vulnerable to a sharp correction given stretched valuations, the weak economy, and contracting corporate earnings, or at least the potential for contracting corporate earnings. What all this has done is left us in suspended animation, which I outlined a few months ago. Though the markets are clearly in turmoil, nothing has yet unnerved the momentum and speculative investors. Many are warning and heading for the sidelines, but fear has not yet gripped the markets. I again stress yet. The headlines are there every day. They are presently just being ignored. How serious are some of the issues? Let's look at some of the financial markets individually. In the international markets, we need to look no further than China, which is experiencing a crash which is the worst, or presently very nearly the worst, excluding 2008, it has ever experienced. China's key stock market index, the Shanghai Composite Index, topped at 5,178 on June 12th and has since crashed 1,402 points or 27% to 3776 on July the 6th, losing nearly $1 trillion in less than a month. To put the importance of this in perspective, China is the world's third largest economy, with a gross domestic product of $10.4 trillion in 2014, as compared to the second largest economy, the United States, at $17.4 trillion, and the largest economy, the European Union, with a GDP of $18.5 trillion. Japan is fourth, way down at $4.6 trillion. Given the interconnectedness of international trade, this is a serious development for the world economy to see the third largest economy stock market getting slammed in just a little over 3 weeks. Greece's GDP is fourth at $240 billion. Who should we be more worried about, China or Greece? Neither are good events and are likely the sparks of future economic collapse throughout the world. Alibaba Group Holdings is also crashing, down 33% from its high of 120 on November the 13th to 80 today. The stock has declined 20% from its high profile initial public offering price of 100 in September. Alibaba was the largest IPO ever back in September. It is a Chinese e-commerce company, and investors actually own units of a holding company located in the Cayman Islands instead of owning stock. The chickens have come home to roost. Looking at the currency markets, there are many stories here to be seen, but the euro risk really stands out. The resolution of the Greek debt negotiations potentially has a dramatic ramification to the value of the euro currency. We currently feel the euro could test parity with the US dollar in 2015 in a trend that could take it much lower over the next few years. The decisions taken over the next few months or even days and weeks are likely to set that course. The credit market are also sending signals which get brief headlines and then ignored and forgotten. I updated this grid, which is part of the GMTP's Aggregate Risk Assessment Index. We have seen a dramatic increase in credit default swap prices across Europe. In the cases of Greece, Hungary, Italy, Portugal, and Spain, their increased percentages have not been seen before. Their levels have been higher, but the dramatic swing is clearly evident. In the U.S. Treasury bond market, bond yields are plunging. 30-year Treasuries are now under 3%. With near-record shorts in Treasuries, once again, yields are collapsing as both a flight to safety and short squeeze have sent the 30-year back below 3% for the first time in a while. German bond yields are tumbling as well, as the entire U.S. bond complex is. What is not followed as closely, but needs to be, is what I see is going on in the muni bond insurers, or what is referred to as monolines. Prior to the 2008 financial crisis, they were the canary in the coal mine as insurers of CDOs. Today, they insure CLOs and, of course, muni bonds, like those under fire in Puerto Rico, Illinois, Chicago, etc. Everywhere we look, we see mounting problems with few solutions and an apparent absence of concern from investors. Greed blinds. Also, fear does when it inevitably and abruptly appears. I mentioned at the beginning that all these developments are resulting in signals being sent that gives us some indication and sense of what may lie ahead regarding policy decisions. These are potential policies which will impact investment decisions and portfolio management. The impasse in Greece was a pension payout and the implementation of that tax problem. The problem in Puerto Rico is pensions and tax revenues. The same story can be seen across America at the state, city, and local levels. When the Greek Prime Minister on Sunday, June the 28th, shocked the EU by calling a national referendum, we saw him forced to reverse his position by Wednesday, July 1st, after ATMs were restricted and, more importantly, pension withdrawals were announced to be limited. No one was more shocked to see the Greek people suddenly and abruptly shift from a majority supporting a yes vote to ensure access to their ATMs and pensions to a no vote out of anger and rebellion to the heavy-handed tactics of the banks and their EU controllers. A 60% majority emerged within 1 week, even though it meant possibly even worse draconian measures. But at least they would be free and not living under what they perceived as German dominion. The signal here is that debt levels have moved to the point where borrowers can no longer afford to pay them due to mounting pension obligations. Central banks and federal governments can no longer afford to guarantee more debt, and the international banks simply cannot afford to take write-offs, which due to their leverage ratios would mean insolvencies, massive counterparty risk, and insufficient collateral to support the $550 trillion swaps market. It's everybody's caught, and the question is, who's going to pay? We also see that it appears that the future debt payments may be extracted by the VAT tax. Many already have a VAT tax. It certainly guarantees price inflation, while questionably believed to deliver increased tax revenues. What we need to learn here is that inflation and higher taxes are ahead to pay the ever-increasing debt levels. Debt forgiveness, haircuts, and write-downs are not in the cards. It just can't happen. The public will pay as the governments, central banks, international banks all win if it does. The next signal we are seeing is the threat of Greek bank bail-ins being on deposit as low as 8,000 euros. Previously, 100,000 US bail-in was considered the low water mark. How quickly the dialogue changes as new trial balloons are placed on the table. We can now expect any US financial banking crisis, and we're going to have one, to be framed in a similar fashion. What would it mean if we were operating a cashless society when this occurred? We would all be under the control of the banks and governments. What we are seeing is that ATMs have become political weapons and potentially a tool to control society during a crisis unforeseen or, heaven forbid, planned. What is driving all this, as we discussed in recent GMTP reports, is that we have a global oversupply based on excess cheap capital for an excessive period of time. That is the consequence of 6 years of quantitative easing and ZIRP. We read, copper crashes in danger of breaching 15-year support level. Why? SocGen says, and I quote here, after hitting the multi-year channel upper limit a month ago, copper is embarked on a steady yet steep downward trend and is now probing against the 15-year trend line. Copper tested that trend line support during last January's sell-off, but eventually did not close below on a monthly basis. In the event of a definite close below, the downtrend would regain bearish momentum and therefore extend towards much lower 2007 lows and possibly even towards the channel support at 5,000, which has encompassed the down move over the last 2 to 3 years. The Financial Times is reporting that emerging markets have shifted from being a major support to world trade growth to significant drag. They're showing that the slowdown in China and other emerging markets represents a significant negative shock to world growth. And I quote, "We would be more confident that the world could ride this out if it were not for the fact that growth in advanced economies is still rather moderate. Demand simply can't catch up, and pricing power, and I repeat, pricing power is not there, and we're seeing it in top-line revenue growth on corporations, which are impacting their earnings. They're running out of runway to play financial engineering games with prices below the non-operating and in earnings per share by reducing the numbers of shares. Top-line growth is not there. Basically, the global economy is stalling from too much debt and excessive supply from too cheap money for too long a period of time. What we have is a decay vortex, which I'll write about in more detail in the upcoming GMTP report. There is a potential recession scare coming, which I have also written about previously. Minimally, we likely will see an earnings recession. We're looking at headlines now that are very, very telling. And we're seeing the moves now placed by smart money and institutional money, which I won't consider smart money, but nevertheless, the trend is quite clear. The headlines are also indicating that corporate earnings cycle has turned. It's shifted, and I am expecting Q3 earnings to be a disappointment. Certainly they'll beat expectations on lowered earnings numbers, but that hockey stick this year just is not going to be met. As we pointed out in previous matter reports, we believe the anticipated fear will be contained within the rising trend channel shown here, at least through early fall. We believe the real deflation leg, which we're currently in, is well underway, though the U.S. equity market prices currently defy it in the state of suspended animation. The U.S. markets may stay elevated for a while, but like Wile E. Coyote, it defies gravity. When the Fed is forced into QE4, which it will be, we can expect real elevated inflation and a strong possibility of eventually seeing hyperinflation. As I am apt to keep saying, never forget, hyperinflation is a currency event which explodes prices higher as confidence in the currency is lost. It will be about lost confidence in the US dollar, and we're a long ways from that quite yet, or possibly the replacement of the US dollar as the dominant global currency in a de-dollarized event, which may be as a result of the controversial Asian Infrastructure Investment Bank. That's a lot closer in and could be the driver. Let me reiterate, I continue to fully expect a Minsky melt-up before all this ends very badly, late 2016. Eventually, it will be clear to all that central bank policies have been a failure. The government's policy of financial repression are becoming too heavy-handed. As productivity falls, high-paying jobs disappear, and tapped-out consumer demand steadily slows. In closing, I'd like to take a moment as a reminder, do not trade from any of these slides. They are for education and discussion purposes only. Thank you for listening, and until next month, may 2015 be an outstanding investment year for you.
This has been Gordon T. Long, editor and publisher of GordonTLong.com. New recordings are posted regularly and can be found at GordonTLong.com. New show notifications are available through RSS feed, iTunes, and other social networking venues at GordonTLong.com.